So we take a look at my top 4 strategies and where we are. Yesterday we talked about a 6-system portfolio. This is a 4-system portfolio. So we removed SR Counter Trend 2, E-mini S&P, and E-mini NASDAQ. And so when asked what are my top 3 to 4 strategies, I've told you it's Cobra 3, E-mini NASDAQ, and then E-mini S&P Night Trader. And then we have these counter trend strategies, E-mini S&P, tick count trend 2 on the 1 minute and then on the 5 minute. And so this is really one strategy, but it's on 2 different time frames. So you could say it's 3 strategies or you can say it's 4 strategies. Realistically, you're trading 4 different setups. And so what are the results on this? Let's look at the equity curve with the drawdown. So it's in a little bit of a drawdown like it's been before. You see this red, when it goes down, represents a drawdown in the equity curve from the last green dot. And so it measures that drawdown. And so these are normal drawdowns. You see this drawdown here. You see it, several different times where it's drawn down. And you see this time period right here where it's underwater for about a year. And so this is normal. This is what is normal in trading. And so you wonder, what is a normal drawdown? How long and how deep do these drawdowns go? And so if you look at the performance summary, you're looking at $12,000 drawdown and time period. It's from trade 1737 to 1988, and then we can look at the total trade analysis or a list of trades to determine how long that is. It's about a year or so. And so let's look at the monthly period analysis. It's down intra-August, halfway through August, we're down 2 months in a row. You see $3,300. There was a $3,200 drawdown here in May of 2018, and then you see a $5,000 drawdown in December of 2015. Then you see 2 months in a row down here, $5,800, and so you don't see the beginning and ending of each of those months. Like you don't know where this drawdown starts in, say, November of 2009. This could have been up, $3,000 at the beginning of November, first 3 days, and then this one may have drawn down from the beginning of November, and then all the way into May, and all the way into February of 2010, and then started recovering at the end of February of 2010. So this could be what looks like 2 losing months in a row. Could be almost a 4-month period where these gains were all achieved at the very beginning of November, at the very end of February. And so here's some drawdowns that you see. 2009 was obviously a very volatile year, and ES Night Trader is long only, and so that's why you see that big drawdown right there. But since 2009, you still see this $10,000 plus drawdown. It was a quick spike, and then you had some bounce back there, and then another drawdown, and then a bounce back. When this red goes to 0, it's at equity peak. So most of the time, you're in a drawdown because you're not at an equity peak. You can't expect to be at equity peaks all the time. And so right now we're in a little bit of a drawdown, which is normal. And we showed the 6-system version of this yesterday. When you click on this checkbox and then run the report again, you will get what we ran yesterday, because it will include E-mini S&P on the Capstone SR Counter Trend 2. And so the more strategies you have, the more diversity you have, and so sometimes the cycles are shorter and quicker when you have more strategies. But this is where we are on the 4-system portfolio. I'm going to go ahead and pause the video and run the latest on the stock index portfolio, so you can kind of compare it and see what the 4-system versus 30 systems. And then let's keep in mind the total net profit. These are on the E-minis, but you could trade these on the micros now, and all the results will be 1/10. So hypothetically speaking, if you trade these on the micros, and this is inclusive of 25 round turn slippage and commission, and so on the micros it'd be $16,800 per micro. The drawdown would be $2,000 or $1,200 instead of $12,000. So I'm going to pause the video. I'm going to load the stock index portfolio and run the report. So I've just loaded the stock index portfolio, and you can see it's from 2007 to 2019, and we're going to run the report, run this setup, and you can see that there's a lot more strategies checked. And so I'm going to run this report. I'm going to do the back testing on this, and I'm going to click on this. This is inclusive of today's losses in ES Night Trader. ES Night Trader was stopped out with this reversal from the yesterday's rally. Anticipated that. Surprised that the market just took such a small piece of news and rallied last night, but that's what happens in the constant quest for a bull market. And huge counter-trend rally. We see that a lot lately in the last few years. And so it's hard to trade. It's hard to trade low VIX, in my opinion. It's also hard to trade massive spikes that happen in a short period of time. And so I'm going to pause the video while the rest of this runs. It takes a little bit of time. I'm going to come back to it.
This is the results of the stock index portfolio. You see difference now that it's at equity peaks recently. And let's zoom in, if we can zoom in here. It made that equity peak, and then now it's in a little bit of a drawdown. You see that spike down to about minus 5K. So that happens. You have quicker drawdowns and run up. I guess this is the longest drawdown right here. And so no matter what in trading, you have drawdowns. You see periods. The periods between the green dots are drawdowns. And so you have to ask yourself, what is a normal drawdown? Trading systems offer you that opportunity, and analysis of combinations of trading systems in a portfolio analyzer like multi-charts, portfolio backtester allows you to see. This one was deep. This was the deepest and one of the longer drawdowns right here. What is the worst case drawdown in this scenario? About 50,000. And so if you're trading a 250K account, that is about 20%. You could trade this with a $500,000 account, and that would be 5% or 10%, almost 10% at 50,000 with the $500,000 account. Or you could trade with a $1 million account. You could make a $1 million allocation, and it would be only a 4.75% drawdown on $1 million. And so that's how you would leverage based on your risk tolerance. And then you look at the annual period analysis and what your returns would be. I'm going to click on that. And so, for example, $1 million, 4.2%, 4.7%, 7.5%, 3.9%, 22.4%. And so those are kind of boring returns, but your max drawdown is also pretty low for a futures day trading portfolio of 4.7%. You double those annual returns if you're talking about trading this with $500,000. So look at the annual period analysis again. So this year, if you had $500,000, hypothetically speaking, you would be up about almost 14%. That would be 44%. This would be 8.4, 9.4, 15%, 7.8%. Those are good returns ahead of industry averages. 7.2, 9.6, 4%, 7.8%. That's on 500,000. Now, if you wanted to risk 20%, then you would quadruple those. So if you're trading this with 250K, you take the $1 million return and multiply it times 4. So almost a 6.8% return would then be almost 28%. This would be 88%, and that would be about 16%. This would be about 18.4%. This would be about 30% returns. You'd be risking 20% of your account when you did that. You could start during drawdowns to buffer that a little bit. Your initial risk could be less than that if you wait for a regular drawdown of about 10,000. Then your worst case drawdown would be 37,000. Your risk to worst case drawdown is 37,000 or 7.4%. And so that would be, again based on you're talking 9.4% of the 500K, about 20% of a 250K account, and so it would be 15 to 16% of a 250K account if you wait for this to go into a about a $10,000 drawdown before you started. That's the initial bump. Future drawdowns would require you to get in and out, and that's a tricky game to play, but it could be systemized on a portfolio basis to do to have that strategy approach. But the goal is to always, you're always managing your risk. You're always looking at this worst case drawdown and where we are at the current drawdown, and try to anticipate what the future gains would be to get the reward. And so that is that's how we analyze portfolios. That's what we take a look at the end of. We developed this portfolio at the end of June, and we said, okay, we developed this at the end of June, and then in July it went through this $7,000 drawdown, and then at the end of July we said, okay, great, it's a $7,000 loss, but the drawdown was bigger because it started at the end of June. The equity peak in June was higher than plus 15K, and so at the end of July, the drawdown was steep. Was I think around. Let's see if we can take a look at this. End of July, it was down in here, and so we said, it's a good entry point for this portfolio. It's in a drawdown, and so you see the red go up, and then a green dot up here for an equity peak. And so if you take a look at let's see where the monthly period analysis again. And so far this month, it's been up as high as about 22,000 in August. And so it's in a drawdown off that equity peak based on some of today's trades. And so that's the update. That's how you take a look at multiple portfolios of multiple strategies and compare them. We've compared a 4-system portfolio with the 30-system portfolio, but either way, drawdowns happen. Drawdowns are normal. You don't get a straight up equity curve. The misconception is that, you have an active algo, it's just going to make equity peaks all the time. Now you're going to go through multi-month drawdowns no matter what. And I know top commodity trading advisors go through multi-year drawdowns. Very elite commodity trading advisors I know go through, one example is a 5-year 60% drawdown. And so that is to help you have some realistic ideas about what your expectations should be when you trade. If you've lost money for a year, that doesn't mean you're a bad trader. That means that your strategy is going through a drawdown, and you want to work hard to make sure that you have a good strategy, and that's what we do.